Hi everyone, welcome to today's video. So the last 2 to 3 years were the best time for the investments, especially after the COVID period. The bull run is on the rise. And in this video, I'll be sharing with you that why I believe that investments won't make you rich. Now, this might sound a bit ironical, but at least in the short term, it is true. Now, the first point that I wanted to share with you is that for the investments to make you rich, you need a certain amount of initial capital to invest in. But if you don't have, then becoming rich, at least in the short term, it is going to be very difficult. Because let's say if you have 1 lakh as an initial capital to invest and you make 100% return on that, you make 2 lakh rupees. It is not the amount of money that you can consider yourself as rich, right? Now, for getting the initial capital, there might be different kind of things that you can do, building multiple sources of income or the saving money as much as possible. But solely relying on investments that can make you rich is quite difficult, if not impossible. Now, you might say that there are stocks that you can invest in, like the Bajaj Finance, which has given tremendous results, like in 2000, like 2003 it was trading at 5 and currently it is trading for 7,000. And similarly for HDFC, it was trading for around 10-15 rupees in 2000s, and now they are trading for 1600 rupees. This is kind of multi-bagger stocks that you can invest in, but you need to hold them for a long period of time, for more than 20-25 years, which can make you like 50-70 times your money. But spotting these kind of companies, it's quite difficult in itself. And for average people like us who are not in the stock market for their full-time jobs, or are not able to dedicate quite a lot of time in these things, it is very difficult for us to spot such kind of outliers. Now, the second point is, if you're not able to pick these kind of stocks and you're not able to hold these stocks for long term, then the best advice that you get is to invest in the index funds, which are the Nifty, which has been giving 12.5% returns for the last 20-25 years. Now, 12.5 results in itself is quite good if we see in the investment worlds, where the FD is around 3-5%, bond returns are around 7-8%. 12.5% return in itself is quite good in the investment world. And if you are able to compound your money on that interest, you actually need a lot of time to consider yourself rich. Now, let's say you have initial investment of 1 lakh rupees and you are making the same returns that the Nifty 50 has given till now, which is 12.5%, and you are invested for a period of 40 years. After that, you will get a capital of a little more than 1 CR. And this is excluding all the fees and the taxes that you will incur on your investments. Now, this actually shows you the effect of compounding. If you have good initial capital, you can make quite a good money in the long term. But let's say if you want to make this kind of money in, let's say, 10 years. So if we quickly update the 10 years, the interest rate that you will need is close to 60%. So in the 10 years, if you are able to get a return of 60% year on year, then you will be able to make 1 CR. And getting 60% return a year is actually next to difficult, and that too for 10 consecutive years. Now, you might say that rather than investing in the stocks or the index funds or the mutual funds, what we can do is we can put our money to the trading. But trading is in itself a more dangerous thing to do, because yes, there are people who are able to make money doing trading, but that is quite less percent. And most of these people are full time into trading, and that's why the average people like us, it is quite difficult for us to make tremendous money in the trading field. Now, if we look at the analysis of the profit and loss of individual traders done by SEBI, we can see that 89% of the traders incurs losses. Now, you can check the whole report in this, that you will find that majority of the traders are in loss. But you might say that there are different kind of people who are selling their trading strategy that will make you money 10-20% a year or more than that. But is that really true? And have you ever wondered why these kind of people are selling those courses to you rather than selling this to some financial entity where they can make like lakhs and crores after selling their strategy to these big institutions? And why they are just selling it for a YouTube ad? This in itself sounds like a scam, because if we look at the recent news, the SEBI has been taking legal actions against these kind of influencers, and most of the time these kind of influencers are just marketing and making money from their marketing strategies rather than their own trading strategies. Like, why they're selling their own trading strategies if they themselves can make these kind of tremendous returns on their investment? And the third reason that I wanted to discuss was that the people are bad at investments. Now, naturally, people are not good investors, at least the people who are not full time into investments. Now, there are different kind of factors. People have biases, people have shortcomings, maybe technically or behaviorally or psychologically. People are not good at investing. So I found this Dalbo study, which actually do the study of the behavioral aspects of the investors, and it has concluded that they lose more money by panicking than the indices suggest. Now, if you're interested, you can go through whole study. And the other point that I wanted to cover is that in this study, it was found that an average investor hold his holdings for a term of for an average of 4 years. Now, this might come to a shock, because if we need to make huge returns in the stock like these Bajaj Finance and all, we need to hold the stock for more than 20-25 years, and we have to go through all the ups and downs and remain invested in the same company. Now, coming to the biases the investors have, I'll talk about the 4 main biases that hold people back making money in the investment world. Okay, the first bias that I wanted to talk about is the loss aversion bias. And this is the one of the biggest bias that the people have, because when they're in the loss, people don't cut their losses. Rather, they believe that the stock will go up in the near future or the markets will recover. And this actually leads to selling the stock at a much worse price and a lot more negative returns. The second bias that I wanted to talk about is the anchoring bias, which is that something has happened in the past will happen in the future. And this can be clearly seen during the Bitcoin rally. So in the past, Bitcoin has given tremendous results, and similarly, people were not selling when the Bitcoin was down and were expecting that if Bitcoin has given this kind of tremendous results in the past, it will give in the future again. Because of this, people are not cutting their losses and losing more and more money. So the next bias is the herding bias, which is, let's say, if a lot of people are panicking and selling the market or selling the stock, that why we aren't. We feel that rather than sticking our neck out of the herd, we should go with them. And this happens quite a lot of times when there are kind of negative sentiments in the market about the economy or about a particular stock. And people are just selling based on the sentiments rather than going through the fundamentals of the company. In the end, I'll be talking about the regret aversion bias. The idea about which is same as the other biases that I've talked about, but the thing is we regret about the losses. And we feel that in the past, if we had sold, we were in the loss. But this time, if we won't, then we might make a profit. And these kind of biases that I've talked about holds you back about making good investment decisions, and make investment decisions putting your emotions aside, because it's not all about the mind, it's not all about the technical stuff, but the stomach. So in the end, investments is a great tool for growing your money, and you can make good amount of money by just investing in the index funds or getting a single digit returns like 9-10% in the long term of, let's say, 30-40 years. But the main thing to consider in the investment world is to gauging your expectations. Now, if you think that you can double or triple or 10 times your money in a short period of time, which is 2, 3, 5 years, it is going to be quite harmful for your financial well-being in the markets, because these kind of returns will create a fake image in your market, which will then lead to biases and the shortcomings and making poor investment decisions. So this is what I wanted to discuss with you in this video, and see you in the next one.